All right. Hi, my name is Charles Rumberger.
Oh wait, for the intro. Wait.
Okay.
We should restart.
I can cut it.
Yeah, my bad. I know you're recording already. But wait, should we each say our own name like last time?
Yeah, we'll say your name.
Okay.
And then Prem at the end, you'll say, and this is our presentation on Dynatrace.
All right.
Mehul, you go first. Your name's up first. All right, ready?
Wait, what? Are you gonna restart?
I'm just gonna hold my hand up so I know when to cut the video. Yeah. I'm gonna do it right now, and then we can start whenever.
Wait, I was so confused. Wait, what? Can I start?
I was just putting my hand up so when I look at the video, I know where to pause. You can go, so I can cut the video later. It's fine.
Oh, okay.
Yeah. You can start literally. That's good.
You didn't put your hand up.
All right,
Okay, here, how about Charles? How about you? You just started off. You started off, and then you say your name first, then I'll say my name.
Oh my
God. All right. Hello. My name is Charles Rumberger.
Mehul, Manian.
Nathan, Dadi.
Prem, Patel, and this is our presentation on Dynatrace.
All right. So Dynatrace is under current management by CEO John Van Sequence since 2008. He previously worked for Adiso Systems and Interwoven as their CEO and has been leading the company since. The company is founded at their headquarters in Waltham, Massachusetts, and is operating in North America, Europe, Middle East, Africa, Asia Pacific, and Israel specifically. It was founded in February 2nd of 2005 with the mission to change the way software is monitored. It serves about approximately 71% of Fortune 500 companies and across these industries, leading to about 2,800 customers total. By servicing these blue chip larger industries, they're able to offer an average ARR per customer of $250,000 each, and their industry ranking in the industry is #1 for AI and cloud integration.
Initially, Dynatrace solve a problem, but they ended up creating a new category, a new industry as a result, and that is a part of the reason why our investment thesis for Dynatrace is long, with acceleration in the subscriptions and the annual recurring revenues, as well as their proven innovative scalable business model. Their leadership in cloud monitoring, as well as many other. Should we go to the next slide, or should I read the? Okay. As important part of the thesis is our industry analysis and the catalysts and risks. The industry specifically is cloud monitoring with a annual 22% growth, and we see this continuing with the huge emergence in the need for technology, and we see that competitors like Datadog, Autodesk, and Splunk are all yet to be profitable. And with that thesis, we see that Dynatrace has recently broken into profitability. We think that the longer the competitive nature continues, we think there's going to be a catalyst for mergers and acquisitions in the future. And because of that, we view a couple of risks as globalization and an oversaturated cloud market, with catalysts such as the huge growth, the emergence of Azure, Google, and partnerships with Amazon Web Services as well. We think that with optimistic earnings guidance and expansions into other markets, that Dynatrace can continue to grow.
In terms of the company's strengths, they do have a growing network of partners across the globe, and their products are widely regarded as top tier and the best in many of the categories they're invested into. And they are a market share leader who's recently turned profitable right before their competitors. For weaknesses, their new features, including business analytics, are still to be tested into the market and implemented, as well as some client frustration with the company's price transparency. For opportunities with the recent hacking of the federal database, this has created a lot of new opportunities for cybersecurity to grow in the future, as well as they're in a good position for their market share to grow in the future. And the demand for real-time unified multi-cloud monitoring is growing rapidly in a post-COVID environment, with the natural work habitat changing. For threats, there is a significant amount of competition, which is entailing margin crunching practices, as well as new businesses seek into the niches to create a competitive edge. And macro forces could decrease spending in the future and negatively impact the IT revenues and earnings. For their ties to Israel, their Israel partner is titled as being a master partner, as well as the Israel partners name matrix. Their office was presented with the Regional Marketing Excellence Award.
Yeah, so looking at the financial snapshot of Dynatrace, it's looking really, really solid. First of all, looking at revenues over time, we see that it has been increasing by a consistent rate, and we do see that going on into the future for the next couple of years at least. Now, the industry itself, like mentioned before, it has a 22.6% CAGR, and we see that ever expanding, and we know with the increase of technology and digitalization of this industry, it's going to be more and more important for these companies to do well, and we do see that happening with Dynatrace. So, also moving on to the debt to asset ratio and like the ways covering their debts and their projects, we do see that it is this ratio is lowering, which is a really good sign because it means that they're bringing in more cash and spending out for these projects. Now, and also as mentioned before, the net income is a really big thing that we want to focus on, because the fact that they're profitable before their competitors like Datadog and Splunk and stuff shows that they have this leverage and this extra foot ahead of their competitors to really make a difference. So another thing is when it comes to their EV to revenue multiple, they are on the lower end of it, not the lowest, but on the lower end of it, which just means that compared to the other companies that may be bigger in size, they are significantly undervalued, and people on Wall Street might not realize that yet. So, and final thing is price of sales have been declining, and that's due to their stellar earnings growth over these past couple of years. So moving on to valuation, here we have our company comparables and our weighted average cost of capital. We do like to see that with these different ratios, Dynatrace is having a competitive edge. When we look at the EV to revenue, price to earnings, and EV to EBITDA, we do see that Dynatrace has a lower value, which is undervalued and not appreciated fully to the extent that they should be. And we know this because their EPS is actually higher than the comparable averages, which means that their earnings is a lot better, and their rate of return and their projection going forward is a lot better. So finally, moving on to our WACC, which will lead to our DCF after this, we do taking these different values of debt to equity, and then also the 7-year risk-free rate, annualized return. We settled with the discount rate of about 4.84%, which we'll be using in our DCF model in the next slide. So here we have our discounted cash flow model. We chose a pretty modest growth rate and different things like the revenue and the gross profit, but we also focus on making sure that it's more realistic and better be underballing it than overballing it. So we do see pretty good growth with their free cash flow and stuff. So for the net working capital, we also calculated that with historical data, and overall together we took these to get a present value of our unlevered free cash flow to get a terminal value of around 21 million using a exit EBITDA multiple. So finally, when you look at these different enterprise value, coming to equity value, we do see an implied share price of about $66.92, which is about a 40% upside.
So for all these reasons and a few more, we're issuing a long position warrant on Dynatrace at a current price of $45.61. We equate that to an almost 50% return by end of year. Our price target of $66.92. Thank you for listening to our presentation, and here's our contact information.